was a quarter that was more value led than it had been in the previous 3 quarters. Part of this was the excitement over vaccines coming out of the COVID environment. So we had excitement about the Democratic election, what that could mean in terms of fiscal stimulus, and then a recovering economy. So all of these things blended together to tilt toward more stocks that had been left behind in the previous 3 quarters. Financials performed very well. You saw energy stocks perform extremely well. Autos performed very well. Material stocks performed very well. So these are areas where we tend to be less invested, of course. In terms of sectors overall that underperformed vis-a-vis the market, you saw consumer staples, which again had done very well in the first 3 quarters. Those underperformed the market, as did healthcare. Our stocks outperformed the EFA benchmarks in terms of relative performance, so that wasn't a negative for us. Overall, I'm pretty pleased actually with the performance in the fourth quarter. We were behind very slightly. Let's call it 20 plus basis points. A lot of that can be attributed to just the energy holdings. We don't own energy, so we lost 40 basis points just from not having any energy stocks. So we're fine with that. We actually think we did, we're really pretty pleased with performance. I think the interesting thing about this strategy is that there are secular, structural, and emerging growth buckets. And our structural bucket can encompass areas that do look more sort of value oriented. We do have a valuation approach to growth. So we are looking at companies that can see these structural change in earnings. There are many we have in the portfolio, and we are relooking at names all the time. If you look at what we've done in the fourth quarter, we have added back some names that we had owned previously, like Atlas Copco on the industrial side. And frankly, we think at the end of the day, the math around growth continues to work. I think COVID lasting longer than people expect is not really in people's mindset. And that's something that I'm still particularly concerned about, certainly as you've seen the rollout of the vaccines being very, very slow. So we're hoping that, the new administration comes in and, gets things very organized very quickly, and we kind of roll through this very well, because we do know that when we look at other markets that handled it better, things are back to normal. So for us, what we're doing is trying to keep a balance of different types of growth, different plays on different things happening. So whatever happens, we are not going to be caught flat-footed, frankly. So we're pretty constructive on the stocks we have in our portfolio. We do have names in travel and leisure which have not performed particularly well throughout the year. They did quite well in the fourth quarter as people were getting excited about the reopening trade. And we're pretty constructive, though, once we get through this, of an economic rebound and participating in that.